Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, August 12, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
So if we look at the landscape today, we're tracking a pretty profound contradiction in our daily desk data.
Yeah, exactly. It's like, imagine the United States government is a household,
Yeah.
right? And they just reported perfectly normal grocery bills for the month.
Yeah.
You look at their budget and think, okay, everything is under control.
Right. It looks stable on the surface.
Right. But then you glance over at their credit card statement and realize they are quietly bleeding a record amount of debt in the background. That underlying tension is exactly what we're seeing in the markets today.
It's the focal point of this deep dive. Mapping out the current market regime really requires us to look past the superficial headlines. We have three critical themes emerging from today's proprietary updates to unpack for you.
Starting off, we are going to dissect a perfectly in-line consumer price index print. On the surface, it brought immediate relief to front-end interest rates, but, well, it's effectively masking a brutal fiscal reality unfolding at the long end of the yield curve.
Undeniably. And second, we'll look under the hood of a hyper-concentrated equity market.
Right, where artificial intelligence infrastructure stocks are surging, yet the broader consumer economy is flashing some distinct warning signs that your portfolio really cannot afford to ignore.
And finally, we will unravel a highly complex commodity picture. We're tracking massive oil inventory builds colliding with a stealth rally in gold.
Which points directly to institutional stagflationary fears,
Yeah.
The macro data just completely dominated the tape today.
It really did. It is the primary engine driving both the relief in short-term rates and the highly specific sector rotations we are tracking in equities.
Moving to today's data, let us start with that macro foundation. Our data deck shows July core CPI printed exactly in line with consensus at positive 2.5% year over year.
And to put that in context, that is the slowest pace of core inflation we have seen since March 2021.
Yeah, the immediate market reaction was palpable. Looking at our latest run, this print effectively removed the tail risk of an upside inflation surprise.
Accurate. And consequently, the MOVE index collapsed by 7.5% down to 72.09.
Now, I want to break this down for a second because the MOVE index is not something, everyday investors monitor as closely as the VIX, but it is critical here.
It is. The MOVE index is essentially the VIX, but for the bond market. It measures the level of panic or expected volatility in U.S. Treasuries.
Right. So when the threat of a hot inflation surprise evaporates, the market requires less premium for uncertainty.
Precisely. Bond traders stop panicking about sudden aggressive rate hikes. That volatility compression is really the key transmission mechanism for today's market behavior.
Understood. So when the MOVE index collapses, it means institutional bond traders are breathing a massive sigh of relief. We saw this immediately in the front end of the Treasury curve.
Which is the part most sensitive to Federal Reserve policy. The two-year yield dropped 1.5 basis points to 4.203%.
And institutional consensus on Fed funds futures pricing now shows a tightening cycle that is steadily plateauing.
Yeah, if we look closely at those futures, the market is pricing roughly 1.7 cumulative hikes by mid-2027.
Which corresponds to a terminal rate of approximately 4.06%, right?
Affirmative. Looking at the immediate term, the probability of a September rate hike is now sitting around 38 to 40%.
So the market sees the Federal Reserve finishing a short sequence and then just pausing, rather than embarking on a prolonged hiking cycle.
On that point, the relief at the two-year maturity makes complete sense. Inflation is cooling, so the Fed can relax.
But here's the twist in today's data deck. Despite the clear relief in the two-year yield, the 30-year Treasury actually sold off.
Yeah, we tracked yields on the 30-year rising 1.7 basis points to close at 5.262%.
And the catalyst for this divergence, the July federal budget balance, it printed a severe deficit of negative $432.3 billion.
That is an $86 billion miss versus the street's consensus. This is where the headline CPI relief entirely masked the underlying fiscal rot.
Let us apply our first principles here, because a bifurcated yield curve can seem counterintuitive to anyone managing a balanced portfolio. Why would short-term rates fall while long-term rates rise?
That's a great question.
Instead of using the old seesaw metaphor, let us think about this like a 30-year fixed mortgage. If a bank looks at your current income and sees your monthly grocery bill, the CPI is stable, they might offer you a decent rate on a short-term loan.
Right.
But if they see you are recklessly running up $432 billion on your credit cards every month, they're not going to lend you money for 3 decades without jacking up the interest rate.
Concur. They need to compensate for the massive risk of default or future inflation. That dynamic is known in institutional finance as a bear steepening of the yield curve.
Exactly. Investors buying 30-year bonds are looking at that $432 billion monthly deficit and demanding more compensation.
What we call a higher term premium. They need that to absorb the absolute deluge of Treasury supply.
They are telling the government that if they are going to lend money for 3 decades amidst severe fiscal imbalances, the price of that debt must go up.
Regardless of what the monthly CPI print says. The bond market is essentially demanding a risk premium for the sheer volume of debt the government is printing.
Pivoting to our second block, we really have to examine how this underlying macro tension translated into sector and equity flows.
Because if the bond market is demanding a massive premium to fund a $432 billion deficit, you might expect the stock market to be panicking.
Right, but the front-end rate relief effectively provided a green light for risk assets today. However, a closer look at our latest run of equity flows reveals extreme market fragility beneath the surface.
The headline numbers certainly look orderly. The S&P 500 closed up 0.26% at 7,748 points 50.
From a structural standpoint, the index is tightly sandwiched between a firm options pin at 7,800 capping the upside and a defined support level down at 7,640.
We should probably explain that concept of an options pin for the listener because it is a mathematical force that dictates a lot of the market's daily rhythm.
Yeah, imagine a giant gravitational pull created by thousands of institutional traders who have placed massive derivative bets that the market will land on exactly 7,800 today.
Market makers, the entities facilitating these trades, have to constantly buy and sell underlying stocks to hedge their own exposure.
And as the market gets closer to 7,800, that hedging activity increases. It effectively traps the index price in a tight range and suppresses volatility.
Affirmative. That hedging activity creates a hard ceiling. But while the broader index was pinned, the internal mechanics tell a heavily skewed story.
The Nasdaq 100 clearly outperformed, closing up 0.74%. That rally was almost entirely driven by a re-engagement of the AI infrastructure momentum trade.
We saw SMCI surge 19%, Letty pulls up 13.6%, DL gained 9.9%, and HPE was up 8.1%.
And this enthusiasm is not confined domestically. Looking globally, the KOSPI surged 3.68% overnight.
Our desk data shows this was driven by reports of intense investor interest in heavy-hitting chip makers like Samsung and SK Hynix.
Undeniably. Investors are piling into the physical architecture required to build data centers.
They are buying the companies that make the servers, the cooling systems, and the actual silicon.
However, there is a severe breadth contradiction unfolding beneath these high-flying tech names. Over 55% of the constituents in the S&P 500 actually traded in the red today.
We are seeing a stark divergence where software names lagged the hardware sector significantly.
Noted. And it is not just software trailing behind hardware. If you look at your portfolio's exposure to everyday consumer spending, those names took a hard hit today.
Consumer discretionary stocks like UBEOR closed down 4.0% and LULU fell 3.8%.
Furthermore, our daily desk data points to a historical collapse in the alpha generated by earnings beats. This is a crucial metric for active investors.
It really is. Historically, when a company announced a positive earnings surprise, meaning they made more money than Wall Street expected, that stock yielded a 95 basis points excess return on the day.
But today, that reward for beating expectations has compressed to just 20 basis points.
So companies are posting unbelievably strong quarters, and the stock barely moves.
I want to break down why that is happening.
Yeah.
That compression indicates a market priced for absolute perfection.
Accurate. It signals that the buy side, the mutual funds and hedge funds, has already modeled in the absolute best case scenario.
Their capital is fully deployed. There is simply no marginal buyer left with fresh cash to push the equity higher on good news.
Because everyone who wanted to buy has already bought.
Concur. When capital is exhausted, you get these muted reactions to seemingly great news. This brings us to a structural contradiction in the narrative that we must challenge.
We have a headline tech melt-up in AI infrastructure. But looking at today's data deck, real average hourly earnings actually turned negative.
Right, dropping 0.2% year over year. The consumer is the engine that funds the rest of the economy.
So, how can the broader market sustain a valuation expansion when the consumer base is technically losing real purchasing power?
That is the exact tension defining this regime. The market is effectively deciding to ignore the consumer because the macroeconomic outlook feels too uncertain.
Instead of expressing broad economic conviction, investors are expressing apathy toward the general economy by hiding in the one sector boasting secular growth.
Artificial intelligence infrastructure. It is a defensive posture masquerading as a momentum rally.
They are buying AI hardware not because they are wildly optimistic about the entire global economy, but because they're terrified of everything else.
They know data centers are being built regardless of what happens to retail spending.
Precisely. They are seeking a safe haven in secular growth, isolating themselves from the cyclical risks tied to the consumer.
Pivoting to our third block, let us look at the raw inputs of the global economy: commodities and hard assets.
The weakness we see in the consumer is mirroring some highly unusual price action in the physical markets today.
Starting with energy, WTI crude fell 0.76% to $82.6 per barrel, and Brent dropped 1.00% to $88.41.
That downward pressure on crude stems directly from a massive Energy Information Administration inventory build.
We saw roughly 17 million barrels added to commercial stockpiles. To put that in perspective, that marks the largest single-week build we have tracked since January 2023.
When you have 17 million unexpected barrels of oil sitting in storage, it signals that end-user demand is significantly softer than refiners anticipated.
On that point, the supply glut wasn't the only factor weighing on oil. Our updates today highlight reports of a U.S.-Iran ceasefire extension over the Strait of Hormuz.
That development helped temporarily remove a significant portion of the geopolitical risk premium from the energy markets.
Right, if oil tankers can move freely through one of the world's most critical maritime choke points, the fear of a sudden supply shock evaporates.
Understood. But while geopolitical risk drained out of the energy market, it is still very much active in agriculture.
Wheat futures spiked approximately 3% today. This was driven by a direct supply shock, specifically a drone attack on Russia's Novorossiysk grain terminal.
Which serves as a critical export hub for global wheat supplies.
But the most revealing price action today, and arguably the most important signal for your broader portfolio, occurred in the metals complex.
Gold surged 0.91% to $4,468 per ounce, hitting a two-month high. Silver followed suit, gaining 0.99% to $65.50 per ounce.
The strength in precious metals is the true anomaly in today's tape. I have to push back on the traditional gold narrative here, applying our first principles.
Go ahead.
Usually, gold performs well when immediate inflation is running hot or the U.S. dollar is collapsing. But today, the CPI print came in soft, showing inflation is cooling.
And furthermore, the U.S. dollar actually picked up slightly today, with the DXY index up 0.17% to 99.98.
Exactly. If immediate inflation is cooling and the dollar is firm, why on earth is gold surging to a two-month high?
That is the pivotal question of the day. The rising price of gold, combined with the rising nominal yields we discussed earlier on the 30-year Treasury, constitutes a classic stagflation signal.
Let us define that for the listener. Stagflation is the nightmare economic scenario where growth stagnates, but inflation remains persistently high.
It is incredibly difficult for central banks to fix because lowering rates to boost growth just makes the inflation worse.
Accurate. And the institutional money buying gold today is not reacting to July's CPI data. They're looking past the current monthly grocery bill.
They are looking directly at that $432 billion fiscal deficit we discussed in our first block, and they are concluding that long-term inflation persistence is mathematically inevitable.
They're effectively using gold as a hedge against sovereign debasement.
They are betting on a scenario where structural, multi-trillion-dollar deficits eventually force the government to devalue the currency over time to manage the debt load.
Regardless of what short-term monetary policy the Federal Reserve implements.
Affirmative. Gold is acting as a barometer for fiscal distrust. It is entirely disconnected from the immediate interest rate relief that the stock market is celebrating.
Moving to today's data synthesis, we need to connect these dots across rates, equities, and commodities to understand what this means for your portfolio.
The overarching regime the market is currently pricing is a soft landing with inflation persistence.
When we synthesize the flows, the picture is highly bifurcated. Equities are wearing blinders.
The stock market is treating the inline CPI print as an all-clear signal to blindly reward AI infrastructure, completely ignoring the structural issues bubbling beneath the surface.
Undeniably, equities see the front seat of the seesaw listing, and they are cheering.
But the bond market, pushing the 30-year Treasury to 5.26%, and the commodities market, pushing gold to $4,468, are acutely focused on the long-term fiscal risk premium.
Yeah, and structural supply chain deficits. They see the $432 billion anvil weighing down the back of the seesaw.
This divergence creates severe concentration risk for any portfolio holding broad index funds right now.
The dynamic we identified earlier, apathy rather than conviction, means investors lack confidence in the broader macro environment.
They're crowding into AI hardware because they do not trust the consumer's purchasing power or the government's fiscal trajectory.
Concur. We must validate this synthesis with a clear warning for how you manage your own allocations.
A market relying on just one single-engine AI infrastructure while entirely ignoring a ballooning federal deficit and a weakening consumer is structurally vulnerable.
It leaves the entire index exposed to a single catalyst reversal.
Precisely. If there is a component shortage, a delay in data center buildouts, or a sudden realization of sovereign debt constraints that spikes long-term borrowing costs, there is no underlying breadth to support the broader market.
If the AI momentum trade breaks, there are no other healthy sectors ready to catch the falling index. To summarize today's action, the CPI relief sparked a hyper-narrow AI rally.
But underneath the hood, consumer real wage weakness, a massive federal budget deficit, and a stealth rally in gold all signal that long-term caution is heavily warranted.
Before we wrap, we want to leave you with a final piece of proprietary intel to consider regarding how inflation is actually measured, because the rulebook is about to change.
Starting this month, August, the Bureau of Economic Analysis is changing its personal consumption expenditures calculation methodology.
Specifically regarding how they measure portfolio management prices. Our internal models suggest the seemingly minor methodological shift will artificially lower year-over-year core PCE by 0.2 percentage points.
So the data will look cooler, but the reality on the ground hasn't changed.
Will this statistical quirk give the Federal Reserve a false sense of confidence to pause their policy, even while the underlying structural inflation driven by deficits remains hot?
Something to keep a close eye on as we move through the quarter.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.